Take your seats, and we'll get the final panel of the day underway. And it's not to trivialize what's come before. It's possible that we've saved the best for last. We'll have to see. This panel is to present the work that is now underway. It's a long way from being finalized, but the newest working group of the Bretton Woods Committee is a multilateral restructuring working group. We know there's been calls from the key members of the G20 and others over time to improve the functioning of the multilateral institutions. And those calls have become insistent, and at least some progress is underway. The working group we have been incredibly fortunate at the Bretton Woods Committee to have as the co-chairs of the working group Axel Weber and Joaquin Levy. Joaquin could not be with us today, but is the help in the chief drafting department for this project. We have Siddharth Tiwari, who's a former colleague of mine and tremendously talented at bringing ideas together and expressing them clearly. So we can look forward to a terrific report. But this is going to be a discussion around the themes. And joining Axel Weber is here, and Siddharth is Xian here, Masood, Ahmed, and Frannie Léautier. You have in your in the I guess in the website. I guess you don't have paper paper bios, but as usual, allow me to. I assure you, if there's anyone here you don't already know, this is an extremely talented and accomplished panel, and I encourage you can look at the Bretton Woods Committee website and you can read their bios, and in the interest of saving time, I'm not going to go through. So I think we begin, Axel, with you, and away we go. Thank you.
Thank you, John, and it's a pleasure being back here. Just made it by 5 minutes from the airport, so just-in-time management worked again. You shouldn't rely on it, I tell you. It was touching up. When we started thinking about the program, we asked ourselves a simple question. Siddharth had the time that he spent with Tom and the eminent person group on the report, and that's a report that is 5-6 years old. And so we took that as a starting point. And we asked ourselves, what has changed since this eminent person group report had been drafted and the conclusions and recommendations given? In short, everything. Bit more in detail, well, we have a war in Ukraine, the first war again since the Second World War on European territory. The rules that govern the international order have changed. The peace dividend has evaporated, defense spending has risen, Germany has added to military spending an amount of spending that they didn't do even when the pressure from the US and others were pretty high to do that in peacetime. It's now just happening. Cyber risks will get further prominence, you will see that, and basically a diminished Russia poses a very big security risk globally. Second, the pandemic. It led to a colossal loss of life, but also strained financial situations in many countries to COVID-related expenditure. Schools were closed. We're losing a few years of the most important parts of these school children's life, and the educational dividend that will come from that, we will have to see. The virus continues to mutate. We are in a sort of more stable equilibrium now, but who knows what can happen. It clearly poses an imminent risk that could materialize anytime again. Climate. Another big risk that was in principle known, but we haven't done anything about it really. We're starting to scratch at the surface, is the climate change problematic. The increase rather than decrease of fossil fuel usage after the war and after sort of the disruptions we saw over the last year is a big concern. Energy security is taking front seat. Energy transformation has taken, at least for a while, the back seat, and that will have implications for the trajectory we will see on climate. We are, again, after 56 years, in a cost of living crisis, I would describe. We've had massive increase in inflation, in particular in emerging markets, and people's livelihoods are threatened by the enormous increase in oil, food, fertilizer, commodities, industrial product prices. This is not like the oil price in the 70s, where it was just a few commodities around energy. This is pretty broad-based. 80% of many of the indices we look at rise with rates above 5%. So we're seeing a cost of living crisis, and that will have very strong redistributional effects, because those who were basically cost of living is a bigger part of what they spend money on will be more adversely affected. We have renewed financial stability concerns. The recent episodes around US regional banks, around Credit Suisse, have already reminded us that basically in the course of adjusting monetary policy, there is some cost, not just due to inflation, but also there is a financial stability risk that has come to the forefront. We need to manage that financial stability risk and price stability risks. The question about trade-offs of monetary policy has rearisen. Of course, we have two different tools. There are different instruments central banks can use, but clearly we are in a period of renewed financial instability with all its knock-on effects. Look at the debate in Switzerland today in the parliament. This has on many people's perception of how stable the financial sector is in the major developed countries. Again, a discussion we could have done without. Digitalization is another big transformer of many businesses, many industries. So if you're looking on the side of what has changed, a lot has changed since that eminent person report has been issued. And last not least, one area that I'm closer to that has really changed is private capital now plays a much bigger role in managing crisis, at least in the expectation that public policymakers have, having gone to the limits of public policy and debt and deficits, that the hope is, can we bring private capital in to solve some of these problems, maybe combined and intertwined with technology, new forms of private investments, co-investment, public-private partnerships, all of these things have come to the fore again. Now, combine that with the last point I mentioned on financial stability. A stable financial sector could fulfill some of these roles. A financial sector that is looking again at its own stability and trying to make sure that they pull through themselves is not going to spend and not be that useful in solving all of these big issues. The global economy and its management has become much more complex, not just at the aggregate level, but also at the individual level. Inequality is sharply on the rise, and that will have very important implications for debates between countries, but also within countries. There is a discussion in many areas between the rich and the poor, between the young and the old. Generational conflicts in an area of where you will see additional burdens being placed on future generations because of current expenditure will be a big issue that we will have to address. Falling productivity as a result of the pandemic is another drag on our economies. You saw the announcements by the IMF and others who estimate that the next decade will see much lower global growth. And with that lower global growth will come much less room between the economy growing at a slow and low rate and a recession that will drive the global economy into rates that are close to zero or negative. Polarization in political decision-making is a new topic that is a challenge. So I could go on. I think I listed enough problems that have made decision-making more complicated since the Eminent Person Group report came out. The big question that we now have to deal with is, what are potential solutions? It's not enough to point out the problems. I had the pleasure of sitting in a talk of Nourid Robini, and after 5 minutes, I asked him, when's chapter 2 coming out, or part 2 of your book that's called the solutions rather than the problems. And that's, I think, where we need to now work. We have a lot of issues that are concerned for the institutions that we're being hosted by here. Both the IMF, the World Bank, the Millennium Development Banks, the regional development banks, all of these institutions are undergoing major discussions about their remit or whether they're up to the job, can they deliver in scope and in time and on scale. And Siddharth, who's working with us in trying to put some of that together, our initial distribution of labor was that he will go into some of the reform ideas that we're starting to discuss around the international financial architecture and the institutions. There's lots of work to go. And just to say, I worked with Joachim Levy quite well when Jim Kim asked me to lead a group that looked into the funding of the World Bank and the International Finance Corporation. This has become even more challenging than anything these organizations have been. Not just do they need more money to do the tasks they're already addressing, they need more money to do a lot of additional things that are being put in front of their doorstep, and they need to adopt this. So, Siddharth, maybe we change podium, and then you can contribute a few of these ideas, or you may want to do it from there. Okay.
So, Axel had a long list of things that have changed, and it's all happened in the last 5 years, 4 or 5 years. So the questions that arise for the panel, and I'll lay out a few, is what is the purpose of IFIs, that even in the era of low trust and strategic competition, are there areas that require multilateral cooperation? And the answer is yes. Can that happen or not? Second, what is the adequate balance between G20 and IFIs? If you look at the Indian website, there are 240 meetings this year. Just do the arithmetic. It's a meeting a day. In that situation, is it possible for IFIs to lead their own agenda, or do you need a right balancing between the G20 and the IFIs? For the IFIs themselves, what would a repurposed multilateral development bank look like? Will they establish rules of the road? Will they assemble financing? Will they do both of them? It's very clear that public and private investment will need to be brought to bear for any of these solutions that Axel laid out. In that, how do they support system-wide risk mitigation? If you talk to an individual bank, whether it's African, Asian, there's concentration risk. But for the system as a whole, there is no concentration risk if you combine their assets. The next is the size enough or not? And Frannie's done quite a bit of work. Masood has thought about it. Do they have enough capital? Should they prioritize an adaptation, or should they look at mitigation, and what is the balance between them? On the financial system, it is fairly clear that inflation was a rude awakening. I think these days, if you go out on the street and you say you're an economist, your capital drops right away. So if you look at surveillance between the IMF, FSB, and BIS, are the risks covered or not? Or are there gaps that are not being covered between these institutions? Who should be looking at inflation? Who should be looking at global risks, whether they are global imbalances, liquidity? Who should be looking at multilaterally consistent exchange rates? The other issue is a system providing financing on tap at scale? Have central bank swap lines fundamentally undermine the IMF? Should the IMF be going first and central bank swap lines second? There is an issue here, and the IMF's liquidity facility has not been used to the extent that people thought about it. The debt architecture is broken. The previous panel talked about it. China needs to be brought, new creditors need to be brought into the net, and that's work in the making. the governance of the digital economy. So data governance is where climate was 20 years back. IFIs are not involved. There are no rules of the road. And it is moving at an exponential pace. And finally, it's something that used to take most of our time before was IFI governance. Quotas, management selection, whether it will lead to a legitimacy gap if it's not covered. So these are some of the areas that we are looking at. I will go through about some housekeeping, about 20 minutes of structured conversation. We will go to the audience, and then we'll close. So maybe I go to Masood, Frannie, and Xian first. Of all the lists that Axel had, is there something you want to add that meets that threshold? Masood, yeah.
I think we've got a good list. So I think adding to the list is not the most productive thing that we need to do. But I want to go a bit to the point that Axel raised, which is the list has been there for a while, right? If you were doing this list a year ago, it would have been a similar list. What's stopping us from making progress in dealing with this issue? And there's one very live area in which we might use as an illustration. So there's a big discussion going on in the World Bank across the street on refocusing their mission statement, trying to see if you can get more financing from their existing equity, and trying to see if they can do a better job of mobilizing private finance. That's a sort of three-part conversation. And 6 months after that, I'm sure many of you have seen the paper the World Bank has produced for their development committee meeting, came out at the end of last month. And you can see that that conversation still has some way to go. And why are we having difficulty? And I think partly my reading is that we have to recognize that in the end, this is not simply a technical discussion. It's a discussion of building consensus around shared priorities. And I feel that so far, we have not made the progress on that building of shared consensus. So if you're a low-income country from Africa, you're coming into the spring meeting, you arrived yesterday or today, you see that the big discussion is about how to balance climate versus development, what's the instruments that will be used and what will be done to raise the equity of the IBRD. But you're also being told by the IMF that actually your financing needs are going to be large for the next 2 or 3 years. The world economy is bad. And you're confronted with two numbers that are really important that matter to you. One is that the IMF's lending through its PRGT to low-income countries is lower than it was a couple of years ago and is being held back. They've increased access limits for GRA account, but not for PRGTs, the concessional window. And they're being held back by lack of money to finance the subsidies. And IDA, which is a much bigger provider of concessional money, is going to do $37 billion this year of concessional financing, and next year is going to drop off to 26. That's a third. So these are the two numbers that are the most important numbers for you coming in to talk to these two institutions. And for them, I think unless we recognize those concerns and build them into the discussion, it's going to be very hard to get a conversation that focuses only on what's going to be the way we tackle climate adaptation and mitigation, even though everybody recognizes that those issues have to be addressed. So I really do think that my one comment now is to say that we have to focus on the process and how we're going to build political consensus across a range of the membership on what is the agenda. And that has to recognize that they are each coming to this with their own set of concerns and priorities, and they don't necessarily share the priors with which we start. So their list may be the same, but the ranking of things on that list may be different.
So just to go through this quickly. Frannie, do you have anything more to add to the list, or you're content?
I think the list is a great list, and as Masood said, probably it doesn't help us too much to add to it. I'll perhaps give color to the list and looking at it from particularly the African perspective. Two things were quite different with the crisis this time around. First, the COVID crisis, and then the banking crisis that we're facing now impacted countries in Africa and the layers of society differently. First, because we have digital banking now and mobile money, governments were actually able to transfer very quickly grants to households and able to soften the risk of the pandemic. That would have been impossible to do 2 decades ago, even a decade ago. So that has helped in terms of the solution space. However, it came at the cost of incurring even more debt because domestic debt had to be raised to meet those solutions. The central banks worked very hard to come up with solutions. The second thing that is different this time around is Silicon Valley Bank, if it had collapsed 10, 15 years ago, it would hardly touch Africa. This time around it did, and it touched the heart of the horses that are driving the African economies, which are the startups. Because they, in getting equity into their businesses, were asked to bank with Silicon Valley Bank. So you would never have imagined, again, this very tight interconnection at a time where the rest of the world is decoupling. So I think these macro interfaces are quite unique and bring a different color then to the type of solutions that you would need to bring to bear. I'll stop here in the interest of time, but I think we need to dig deeper into those because they have created solutions which we wouldn't have had before, but at the same time problems that we still are beginning to unravel.
Great. Axel, I'm going to skip you on this round. Xian, anything to add?
Not much. I agree. I think that the list was the right one and long enough. I think to reach consensus among the stakeholders, shareholders of these international financial institutions, I think it's not a technical issue. It's a political economy issue. And also, as Masood said, each of the countries, mid-income, low-income, their ranking are very different. Their priorities are different. So how eventually find a sort of a common denominator? Eventually, people can really endorse that this is the priority list, and meanwhile, incorporate my concerns as well. Probably that's something. I happened to attend the consultation meeting in the World Bank for their evolution paper. I think you can see interestingly, and different participants try to raise the different concerns, pretty much like lobbying the World Bank to do more for me. But eventually, this is more or less like a zero-sum game. So I think that probably we need to think not only what to do, but how to do it by these international financial institutions.
Okay, so look, the first question is always the simplest. It's to you, Axel. The World Bank's talked about a lost decade. If you add the losses from COVID lockdowns and inflation, the bottom 2 billion have lost about 1/4, 1/3 of their assets through this. We're going to hand the younger generation the worst world than we got. So the question is, has your generation, my generation failed? And what is the possibility to prevent a lost decade?
Well, I think it's pretty clear to me that we are in a new world. Most of the crises we talked about, whether it's COVID, whether it's the war in Ukraine, we're talking about global problems. And whilst we do have institutions like the IMF and the World Bank, we don't have a global strategy. There is no global strategy, and because that's why a lot of what these institutions do, you look at the sum of the parts and it adds up to something, but we really need a global strategy because of a couple of mismatches. The first mismatch you face is all of the restructuring costs in a corporate world, when you do anything, are upfront and the payoffs are later. That's exactly where we are now. We face huge costs today, and the benefits will only be reaped later. And the benefits might be opportunity costs of things not getting worse than they would without the current interventions. The second mismatch we have is no longer can you solve a climate problem by a country X investing in country X to do its climate transition. You actually get a lot more bang for the buck if country X invests in an emerging market economy that doesn't have the means to invest in its own energy transformation. 60% of the money needed will be energy transitions in Southeast Asia, and they will not come. That money will not come from that region. You need to reverse global capital flows, where at the moment, the US as a capital market is sucking up global capital from everywhere in the emerging markets. You need to re-engineer that flow coming from the US and Europe into Asia. But the metric is not going to be, it's not about liquidity. That's the biggest failure that institutions here talk about. It's about solvency. You will not get a return on these investments on climate that will be leading to a future income flow that allows you to pay that money back. The return on that is a change in the climate and something that is good for the planet and preventing worse. So the usual liquidity and other forms of intervention we've seen through the fund will not work. This is about giving money for good, for projects where the money is invested for good. It stays in these countries. It will not be paid back, but it has a bigger bang for the buck if it's invested in these countries and their energy transformation than in the established world where we've already progressed. And that requires a global strategy. And with the war in Ukraine, my feeling is we couldn't be further from a global strategy to use the global institutions with a common sense around the table between all stakeholders on the G20 to agree on something to do jointly for the benefit of the planet, because we're having a global problem and it needs a global solution. Everyone thinks in their remits, in their institutional setups, and in their mandates. And it doesn't add up to more than just fulfilling these mandates. And so I think you need to completely reset the dial. And for me, the biggest challenge is finance. I mean, people talk about building a green corner in the financial universe, greening finance. It's not about that. It's about inventing a new universe of finance that is green. It's not greening finance, it's financing green. What you need to do is have a green transition. And you need to take all the money from anywhere where you can get it to finance that. And it's not about changing the financial system. It's about creating the funds that make industry and that create a transition of our energy backbones in our countries, and mostly needed in those countries where fossil fuel is still a cornerstone of the energy backbone of these countries. These are completely new problems because they're global. And we have global institutions that can coordinate national programs. But we don't have global institutions that match programs for global commons. That's where we need to get to. And we need to get there fast. And I really think that this is a totally different approach we need at the global level than what we've pursued so far in meetings like that. It's really about a global strategy, jointly decided and implemented. And you don't invest in your own country, you invest where the money brings you the most bang for the buck to solve a global problem. And so these mismatches need to be overcome fast in order to make it work.
So this is a good segue for 3 questions on the World Bank. I think we go straight into it. Masood, the previous discussion before this panel, there was a discussion on what's the right balance between the global commons and other responsibilities of these institutions. 2 questions. Should global institutions be entirely focused on the global commons and leave other responsibility to other institutions? That's the first one. And if the answer is no, then what is the right balance?
So quick response to your 2 questions. I think you could have a system in which you could say global institutions work only on global problems, but other institutions in the system then complement them and do other things. We don't have a system. And we're not talking about the reform of the system because I don't think we're coherent enough for the reasons that Axel said to be able to have a global strategy on anything at the moment. So at the moment, the discussion is what should the World Bank do? And if you look at the World Bank group and say, what should their balance be on global problems versus country level support, I can make three propositions. One, that 5 years from now, their focus on global problems should be substantially higher than it is today. And as a share, their work on country-level problems should be less. Second, that while the aggregate will represent that, their work in individual countries will show very different balance between the focus on global. So mitigation work done by the World Bank needs, in my view, concentrate in 10 or 15 countries, because those are the ones that will drive emissions outcomes. Adaptation work much more broadly. Low-income countries, Africa accounts for virtually nothing in terms of emissions. Focus on doing the broad-based support you're doing. And the third point I would make is 5 years from now, the transition from where we are today to where they need to be is going to be much easier to accomplish if the aggregate volume of World Bank support is larger than it is today. It is easier to change the share in a growing pie than it is to restructure the existing pie. And we have to recognize that the level of ambition we have to address these problems requires an increase in the amount of work the World Bank, lending the World Bank can do, financing, and that while a part of this will come from better use of their equity, it will also require inevitably injection of new money into the system. You get a lot of leverage from the MDBs, but any multiple of zero is zero. So you have to think about this as part of a growing pie.
So thinking about a growing pie, Frannie, last year you presented the CAF report to the G20. Where do we stand now on the implementation of the report? And what do you expect for the rest of the year?
So I think, first of all, the report was very well received by the shareholders, by the credit rating agencies, but also by the Multilateral Development Bank. So where we are today, there are a group of banks that have already redesigned their risk appetite frameworks. They've consulted the shareholders, they've delinked it from the ratings of the credit rating agencies, and come up with their own framework. Unfortunately, it's mostly the private sector facing MDBs who have done that. The others who are more sovereign focused have not done the same type of exercise. So I think it will be helpful for them to do that as well. The second thing that has changed is the thinking around callable capital. And I was thinking earlier when you listened to the conversation, and particularly John's remarks at the beginning, if we didn't have the Bretton Woods Institutes today, we would have to create them, because the problems we are looking at are uniquely best dealt by these types of institutions. And you look at the instrument of callable capital, which was created back then because all the countries were poor after the war. We're in a similar situation today. Public sectors are very depressed in terms of their ability to act. Governments are poor. So can we come up with an instrument like callable capital that gives a common or collective guarantee to be settled later when the risks materialize, that could then help us solve the global public goods problems we're facing, climate risks, and of course the development agenda. So we do have opportunities for that. And I think when you look at the banks that have tried to use callable capital in that way, they have managed to do it and increase their lending envelope. The third thing, and here we're very excited about the response, is all our recommendations around innovation. All the MDBs have taken those up with great enthusiasm, and the panel that just ended today here on the private sector role has really taken front and center in that conversation. We look, for example, at instruments like guarantees. Guarantees have the advantage that they can stretch the public purse to cover a wider range of issues, because it's only called when those guarantee targets are triggered. So I think it gives the public sectors of our country, many of our countries, the ability to fund more. The same thing is true with insurance. There are lots of insurance products we could do, and I was very happy to see on the panel here that John was involved in the creation of MIGA. So MIGA in our report has a very important role in saying that why is it only focusing on supporting the World Bank? it could do a lot more with the other development banks. And maybe that's where we can get this global strategy, where you have the World Bank taking a lead and coordinating activity at the global level, but then having the regional banks come in with support from MIGA to do a lot more. I think that was one of our key recommendations as well. But then we also realized that the credit rating agencies actually don't understand the MDBs very well, because they're a very small part of their business. They're mostly focused on commercial banks following the Basel, particularly Basel III framework. And the MDBs don't have such a common framework or common principles to look at. But fortunately, in Paris a few weeks ago, there was an agreement which at the G20 meeting that the credit rating agencies could actually work together to agree on common principles. We think this is a breakthrough because it would allow the banks to reform, for example, the E2L ratios, which the World Bank is going from 20 to 19%, without losing their high ratings, the AAA ratings. And that could allow them cheaper access to capital from the capital markets and still allow to do more with what liquidity is available out there. And then the last area, I think, and here the MDBs are working together, but not as much as we thought they should, which is on making statistics available to the public sector so that investors would know better how the MDBs are functioning and therefore place more resources there. The credit rating agencies could use that to better rate the MDBs and give them the full credit for very unique features like callable capital, like preferred creditor terms, and so on, but also so that the MDBs can be benchmarked. Because right now you find a lot of innovation amongst those that are capital poor and very limited innovation in those that are comfortable. And so if one can raise the pressure points and bring more discomfort, we hope we'll see more innovation. And that's why we focus really on saying, let's do those reforms first before looking at capital increases, because those would be beneficial even when you add more capital to the system.
So, Xian, last night you and I were talking about the impossibility of achieving several of these aims together. AAA rating, increase in lending. Do you want to go through for the audience and the panel?
I probably share sort of my own experience. I moved from World Bank 6 years ago to this new development bank set up by the BRIC countries. And then initially, we're also facing the challenges, how we want to position ourselves, but also in terms of if you want to go to the capital markets like others to raise funds, you need to get the rating. Of course, you want to aim at AAA. By my boss, the president of New Development Bank, happened to be an Indian commercial banker. So he looked into the situation, and then he told me to say, oh, well, I don't know whether that we should really go aiming at AAAs, because in order to get AAA, as you said, the rating agencies, a lot of even irrelevant questions, they try to put you into the framework they set for commercial banks mostly. Secondly, I think that like World Bank and others, if you want to keep your AAA, you need to keep very generously a big reserve. So in the words of my president, he said, you have to sit on the tons of cash, whether that is worthwhile. Because he said in the business communities, a lot of quality companies whatsoever, they no longer pursue AAA as their fundamental goals. So this is sort of, I call it as a trade-off. If really, for example, the MDBs, World Bank included, if you see politically now is not high time to ask for another big capital increase. On the other hand, in terms of stressing your balance sheet, you also want to maintain the AAA. How much space left for you really to go up with your lending volumes? That's probably is a $1 billion question.
I'm looking at time, and maybe I take it towards the financial sector issues now and condense the panel a little bit. Axel, two questions for you. First, central banks have been involved quite a bit in what they call as a just green transition. So as a former president of Bundesbank, what is their role and how should they discharge it? And second, if you look at the VO, China and India will contribute more than 50% of growth this year. One big request of emerging markets has been that the IMF provide financing at scale rather rapidly as they need. And it's not that the IMF has not tried. The liquidity facility was put in place, but it's not being used the way many people thought it should be used. So how can the IMF expand its balance sheet in a fast manner to support emerging markets? Should they borrow from the market? Are there other ways to do it? But how do they support emerging markets better?
Well, so I have two very distinct views, which will probably not be very popular in the room. The first one is, I think central banks were created with a very narrow remit to control inflation, and for that, they're a bit outside the general political process. If we rely too heavily on central banks because they're bureaucratic institutions to do a lot, it's actually, for me, a bankruptcy declaration for democracy. Because we cannot do that. What is required here is not central bank reserves to fund the IMF to do more lending. What I said before is this is investment. This is investment in a better future. It needs to be tax financed. Just ask yourself for 1 second. Future generations already inhabit a planet and a level of debt that is unprecedentedly bad in terms of environmental discussions and unprecedentedly high debt. You want to add debt to solve the problem? You need to have taxpayers' money from mature countries invested in this in order to achieve a turnaround. And you need to invest it not in the mature countries, but in emerging markets. And the only way to go is to really be honest. We have overburdened future generations already. They refuse, that's the only thing they can do is to basically refuse to be born. And that's why we have so bad demographics. Because a lot of people that think about their children are asking themselves, do I want to put them in this world down the road where they inherit more problems? So we've caused these problems. We need to spend our money on solving it. We don't want to borrow from the future. We've done that and overextended on that. We need to now invest taxpayers' money. Governments are elected to run the show. To ask central banks to finance it, in my view, is not going to work. This is a government job. Just tell your taxpayers, your money is up for grabs and we need to invest it. Do your job. That's why you're elected. You're not elected to do different things. And so I think governments need to really change and face the responsibility that they walked away from for generations now. If governments don't solve this, I don't see the private sector solving this. And actually, I see a big risk of us creating a third best world. Banks have been told don't invest in infrastructure projects because they're long-term, they're risky, and governments can renege. So we treat long-term investments by bank as a default-like investment and put a maximum capital charge on it. So banks stop doing that. Now we're asking the World Bank to issue an insurance to the banks so that the banks would do this business that we've made impossible for them to do with capital regulation. And we now put the World Bank and the IMF into a first loss piece that before the banks lose anything, the World Bank and the IMF lose a lot of money. Hey guys, wake up, this is third best. We got to reconsider that something that has an environmental return should be at a discretionary investment doable and positive terms. We need to match financial returns, which is what it's all about in the financial world, to environmental returns, which it's not about at the moment. And the only way to do that is have adequate carbon pricing adequate carbon disclosure and long-run implications in terms of carbon exposures into the financial world. It really is about changing finance to finance green. And in my view, before we do that, we will always work at third-best systems where we shuffle money around that nobody has without telling taxpayers that they need to pay up. That's an unpopular message at every election. The returns are in the future, the costs are now. No government wants to do that. They don't get into power if they do that. So we need to grow up at the level of the planet and start focusing on the right things. And I think it's time for governments to really do their job. They haven't done that. They relied way too heavy on central banks to use easy money to solve these problems and push them into the future. We now need to solve the problems, and not with easy money, but with real money.
And how about financing of EMs, IMF?
Well, look, the IMF can play a role, and the IMF draws on currency reserves created by central banks, and that will continue. It's part of the solution, but it cannot be the entire solution. It's part of the picture. If you ever solved problems, and I've had jobs over the last 20 years, I'm actually quite glad I don't solve current problems, but there are many, if you solve problems, there are never corner solutions. You always use all the tools at your disposal to create an internal solution where you do a bit of that, and a bit of the other. Central banks and the IMF will play part of the role of doing this. But we shouldn't rely exclusively on the IMF and the World Bank to get it done. Everyone needs to face their own responsibilities, and first and foremost, governments need to face their responsibility and not push problems off to the IMF. The IMF can help at the global level to coordinate, but governments need to be willing to take money into their hands and move on these problems. Without that, the IMF will not have enough resources. So yes, it will be part of the solution, but it will not be, in my view, the core. It will be a peripheral part of the solution.
So we have 3 minutes left. I'm going to skip questions from the audience. I'm going to go down the line, 1 minute each panelist. What is one suggestion that you would provide the incoming president of the World Bank? Masood.
I would say to him that your one biggest challenge for the first year is to build consensus among your shareholders on your strategy. If you don't achieve that, then you will spend the next 4 years of your first mandate trying to pick up bits and pieces to fix it.
And the strategy is all around the global.
It's all around how you balance different challenges, old and new, and how you take on board the legitimate but different concerns of different groups of shareholders.
Frannie.
I would say to him, there's a lot of innovation going on within the client countries, within the World Bank itself, and that if you can harness that innovation and then get the strong shareholder support to redefine the risk appetite and do the kind of things that Axel has been saying, then he has a great chance of getting there with unique solutions.
Xian.
I was a World Bank staff before. I think my advice to him that since he is from private sector, probably should to try to bring some relevant private sector practices into the World Bank, so to change the image as international bureaucracy. But on the other hand, I would not advise him to have another round of major restructuring, because then World Bank staff probably will cross 19th Street to join IMF.
Axel.
Yeah, I think, he knows a lot about credit cards and credit. I think this is about real taxpayers' money. And my advice would be rally the governments behind you being the global institution that coordinates national efforts, but make it clear that the national efforts involve national money, but it needs to be spent outside your national jurisdiction in order to achieve a global alignment. And I think that idea that, for example, your national development agenda can be credited even if you invest outside your own country and contribute to achieving your Millennium Development Goals by investing not in your country but in a third country, that's what we need to do. You need to, if you look at global commons like the Amazon, we need to pay for all of the people that are currently doing activities that have a negative environmental impact, for them to move to different activities and to replace these activities. And for that, you need money from the mature world. Like after the Second World War, the mature countries need to understand that this is an issue where their money is needed to help less developed countries fast-track their transition to better energy. That's what it's all about. It's not about the mature countries that already have a pretty efficient energy backbone. It's about spending the money where it's most needed from where it's best, where it is available. And that means reversing global capital flows. He will understand that because he led a global company. But he needs to do the opposite of what the company that he was joining was doing, and that is basically channeling money into the US capital market. He needs to channel money from the US capital market into emerging markets, from Europe as well.
Okay, on that note, we're going to stop the panel. Join me in thanking all four of them, please.
We've kept you well over and into dinner, so I'm going to be very brief in closing. Thank you very much to the panel and all the speakers today. I thought it was a really excellent conversation. I hope that wasn't too downbeat of a message to end on. We certainly have a lot of work to do. I just want to do all my requisite thank yous. Of course, thanks to all the speakers, thanks to the audience, thanks to my wonderful leadership, and thank you to my very hardworking staff who made this all possible today. They have spent a lot of time putting this together and have done an excellent job. I want to thank the Managing Director and the IMF for hosting us, as always. Also, President Malpass for joining us today and for his leadership, as Bill Rhodes said. We wish him well and look forward to continuing a longstanding relationship with his successor. With that, I'm going to close us out today and invite you all to a reception out in the annex area. There's food and drink. Please join us out there. Thank you all very much. Thank you.